Welcome to a brand new deep dive. Today is March 23, 2026, and, well, you probably already saw that about 14 to 15 lakh crore of wealth just evaporated from the Indian market today.
Yeah, it's genuinely been a brutal session to watch.
Right. But the scariest part of this post-market report isn't just the Nifty dropping like 2.6% straight through that 22,500 support level. It's that gold is crashing right alongside it.
Exactly, yeah. Usually a market dip is, just a localized weather event, like a bad earnings report raining on a specific sector.
But this isn't weather, it's a tectonic shift. So, okay, let's unpack this Dalal Street bloodbath and extract the signal from the noise for you.
Let's do it, because the root cause, the real epicenter of this earthquake, isn't actually in Mumbai. It's the Strait of Hormuz.
Right. The U.S. and Iran conflict.
Exactly. President Trump's 48-hour ultimatum to either open the strait or face the complete erasure of Iran's power grid. It fundamentally repriced global risk.
And Iran's counter-threat to target U.S. energy facilities is what triggered the immediate mechanism of this crash. I mean, oil. Brent crude instantly spiked over $110 a barrel.
Right. When two major powers threaten to dismantle global energy infrastructure, the market doesn't wait to see who blinks. It prices in the worst-case scenario immediately.
And think about India, which is basically a giant engine running on imported fuel. We import 80% of our oil. So every $10 price hike isn't just a corporate issue. It acts as a direct tax on the whole economy.
Yeah, it's a massive hit.
It shaves like 30 to 40 basis points off the GDP.
Yeah.
So what does this all mean for the currency?
Well, if we connect this to the bigger picture, that aggressive dumping of our currency to fund those expensive oil imports is an automatic devaluation mechanism. That is exactly why the rupee plummeted to an all-time low of 93.97 per USD today.
Oh, wow, 93.97. And that devalued rupee immediately triggers the FII exodus, I imagine.
Yeah, because if you're a foreign investor, a collapsing currency eats directly into your dollar-based returns. No wonder FIIs panicked and dumped 1 lakh crore this March.
Just massive capital flight.
Exactly, dragging down global peers like Japan's Nikkei and South Korea's Kospi right along with us.
But here's where it gets really interesting. According to the data, gold has actually dropped 18% since this war started. Shouldn't gold go up in a crisis?
In a textbook crisis, yes. But when you face the potential disruption of global energy grids, we moved past a standard flight to safety.
So it's not normal hedging?
No, it's a pure cash is king liquidity panic. Institutional investors aren't seeking traditional safe assets. They're facing steep margin calls and sheer uncertainty.
So they just liquidate everything.
Right, everything, even gold, just to hoard absolute pure cash reserves.
That desperate grab for liquidity really explains the chaos underneath the index level. Like L&T dropped 3.3% today.
Which makes mechanical sense. They had to abruptly suspend 5% of their Middle East projects due to the conflict zone.
Right, and HDFC Bank dropped 3.9%, caught between that broader liquidity squeeze and, the instability of their chairman's sudden exit.
Yeah, exactly. But capital doesn't just disappear, it rotates. Take DCX systems.
Wait, they surged, 13.5% today? In the middle of a bloodbath?
They did. The logic there is clear. In an era where global supply chains are being weaponized, a 563 crore domestic radar order makes a defense stock like DCX virtually immune to those immediate macro headwinds.
That makes total sense. And domestic investors are recognizing those pockets of resilience, stepping in to buy 86,700 crore in equities today to hunt for that long-term value.
They are, though the short-term reality is that the Nifty is going to face brutal technical resistance if it tries to push back up into the 22,700 to 22,900 range.
Right. So for you, the listener, the immediate takeaway is to just step back from the daily ticker. Don't panic. If you zoom out to a 7-year horizon, these crises create severe mispricings.
Oh, absolutely.
I mean, companies with robust cash flows funding structural shifts, like Tata Steel pushing forward their massive green steel project in Ludhiana despite today's 4.6% drop, those become the real buying opportunities.
It really forces a total reevaluation of risk. If a global panic reaches a pitch where even gold crashes because investors are desperately hoarding cash, what becomes the true safe haven of the future? And as geopolitical warfare increasingly targets the very infrastructure that keeps markets online, how will central banks ever accurately price that kind of risk?